Good afternoon. So, for those who don't know me, I'm a physicist. I did my PhD in particle physics at the University of Madrid. And then I moved to South America and worked as a researcher in the capital of Peru, in Lima. And Lima and Madrid, I mean, what do both cities have in common besides they're Spanish speaking? First of all, it's hot. It's really hot. Then the second similarity is they have a lot of inhabitants. Now, hot temperatures on the one side and many, many people on the other side, that is not always a great combination. So there's one lesson you will learn very quickly, and that is leave your kitchen clean. Leave your kitchen clean and don't leave any food outside the fridge, because once you have a cockroach in your kitchen, dozens will follow. It will bring its entire family. And actually, this fact made its way into one of the most famous quotes of our intellectual idol, Warren Buffett. He says, "Problems in a company are like cockroaches in the kitchen. You will never find just one." So if you stumble over a problem in the company, it's very likely that further issues are lurking under the surface. And how does this teach us how to, or in the way how we invest? Let's look at an example of the company Dentsply Sirona, which is a US dental equipment manufacturer. So it produces or offers products such as dental chairs, X-ray devices, dental software, some tools for polishing your teeth, or implants. Now, going to the dentist is not only no fun at all, you also hope that your insurance is going to cover the costs, because dental services are expensive, very expensive. So it's fair to assume that a dental equipment manufacturer like Dentsply Sirona is operating in a market which is highly profitable and lucrative. Therefore, it's no surprise that our AI model, which only looks at fundamental data and not at any stock price or momentum data, proposed this company as a possible candidate to invest into. However, this year, Dentsply Sirona delayed the submission of its annual report. And when it finally was available, you could find the reason. So they say, we restated previously issued consolidated financial statements. So they restated their financial numbers. Now, a delayed submission of its numbers due to previously incorrectly published financial figures is one of the most troubling news you can get as an investor. Because if you can't trust the numbers, how are you going to value a company? So I'm not judging whether this is in intent of a fraud or just some unfortunate mistake, but at the current moment, I don't want to invest into this kind of company. Because there's a risk that further cockroaches are hidden under the rug. And even if they're not, there's still a risk, because the delaying of the annual report destroys trust and confidence. And trust and confidence are one of the most valuable assets a company has. Warren Buffett, he says, it takes 20 years to build a reputation and only 5 minutes to ruin it. So what does this example teach us? It teaches us that if you find a company with some issues, if you have a company where there is some probability of a downside risk, as an investor, you should walk away from the investment. And these guidelines are guiding us in the way how we approach value investing by AI. So today I'm going to talk about the Acatis AI US Equity Fund, which is a fund with a very unique feature, because every investment decision is taken by AI. There's no human intervention. And you have seen this illustration already early on in the afternoon. So this is how we sketch the typical work of a value investor. He has its sources of information, like financial reports, newspapers, conversations with experts, and then he's going to analyze or process all the information in his head and comes up with an investment decision. And our mission, or our goal, was to replace the human being in this process by AI. And our solution in this fund is a two-step process. In the first step, we have the so-called fundamental AI stock picker, which is going to propose companies to invest into. How do we do that? Let's start with another principle of value investing. If a business does well, the stock eventually follows. If a business does well, the stock eventually follows. So if a company grows its sales, if it improves its margins and increases its market share, you don't have to worry, because at some point the stock pricing is going to reflect that the business is operating successfully. And therefore, for us, it's natural that the only input information we are giving to our models are fundamental data. Another pillar of value investing is only buy something that you'd be perfectly happy to hold if the market shuts down for 10 years. Obviously, we have a long-term investment horizon, and this will never change. Acatis is in the business of investing and not of trading, so we always will have a long-term investment horizon as a goal. Now, based on these two pillars, we are building an AI model which is going to calculate an attractiveness score for each company. And you have seen how this works before. It's just a sketch, so it looks very similar to the one to the explanation my colleague gave before, but it's only a very an overview, and actually the models are completely different, which are the thing which is working under the hood is really very different. So I might make it brief. So we're going to zoom into the single sectors, like the IT sector, and then we are constructing pairs of companies which have to compete in a supervised setup. And the task of the model is to identify the likely future winner entirely based on the development of the fundamental data of the company. That's it. And at the end, we get a list of companies, a ranked list of companies for each sector. Good. Now, the second step in the process is the so-called AI textual-based safety net. And as the name suggests, we are analyzing text data. Now, if I want to use text data, I require two characteristics. So first of all, I want to extract information that I can't extract from the numbers, from financial figures, though it should be complementary to fundamental data. And then I also want to incorporate another pillar, another principle of value investing. Rule number 1, never lose money. And rule number 2, don't forget rule number 1. So with the text data, and this is important really with the text data, we're not trying to maximize the profit. We only want to protect against downside risk. So we are using text data only as a protection against some events that may happen with the information we can't extract from fundamental data. So, and this is how we do it in the fund. So first of all, we look at earning calls. Earning calls are conference calls where the management of companies discusses its latest financial numbers, followed by a Q&A session with analysts, investors, and media. And it's particularly this Q&A session we are looking into, because there the management has to respond spontaneously without having some prepared answers already. And then we are using some kind of ordinary tools to analyze the tone or the sentiment of the choice of the words of the management, and we try to evaluate whether management is going to, or is trying to avoid certain answers by just responding evasively. So this is spoken language. Then we also look at written language, and there we have a tool from Bedrock AI, which looks for risks in SEC filings related to fraud, lawsuits, and litigations. So it's like a dog who sniffs through the footnotes of the filings and tries to find some suspicious passages. So 2 steps. So we analyze earning codes, and then we have a machine-learned risk detection in SEC filings. And then again, this is an important point. We only use text data to reject companies. Okay, we're never going to use text data to propose companies, though I don't require a company to have a perfectly optimistic view of the management of the future, but I don't want to have a company where something might be suspicious. So let's look how our text tools operate in real life. So this is the annual report from our earlier friend Densply Sirona. And we are giving this document to our tool, and the tool is going to highlight passages which it thinks are suspicious. And if you read through these lines, you see it's exactly the information I showed you earlier, that there was some restatement of financial numbers. And furthermore, it detects that the person responsible for these numbers, the CFO, resigned. Looking at the risk score of the company, we see that as soon as these 2 passages are detected, the risk score jumps into the red area and says, reject. Don't invest into this company. And with this, we have all the tools for our investment process. So it's a North American fund. So we are investing into US and Canadian stocks. We exclude real estate and financials, and we demand a certain market size of 3 billion. Why do we exclude financials? Because it's not within the circle of our competence. Again, I'm going to quote Warren Buffett. You only have to be able to evaluate companies within your circle of competence. The size of that circle is not very important. Knowing its boundaries, however, is vital. And we know that certain financial numbers have a different meaning for financial service companies. Therefore, we avoid the sector. The next step is the AI stock picker, which is going to propose companies, followed by the AI textual safety net, which might reject companies if there's something suspicious in its spoken or written language. And at the end, we construct a portfolio of 50 stocks, again, in a sector-neutral manner, meaning that if in the benchmark we have a 20% weight in pharma, also in our fund we have a 20% weight in pharma. And we do that because we want to avoid risk. But because remember, we are not using any macro data. Okay? And the training of our model only works within a given sector, but not between companies of different sectors. So we don't have any handle of evaluating which sector is going to outperform, and therefore we take the choice of lowest risk, which is concentrating ourselves on the business we do, and that is stock picking. And then, because we had several questions on that today already, we are going to rebalance our fund every quarter, because every quarter in the US you get new filings. That's a sensible choice. Just to give you an impression of the companies we have currently in the fund, this is getting okay. I'm not going through the names. Just have a look and get a feeling for the companies. Here we I'm now showing some live results. So we launched the strategy in October of last year. The fund performance is in blue. The benchmark, the S&P 500, is in red. And we had a fantastic start until February, March, April this year, where we suffered several weeks in a row. And actually, it's very interesting to look into what happened there. So here I show you the contribution of the 15 largest stocks of an index to the overall index performance. And on the left, you see the stocks 600. And if you look at the dark blue line, you see that the 15 largest stocks of the Euro Stoxx 600 contributed almost 40% to the overall index performance. And that's okay. It's not something very which knocks you out of your socks. But let's go to the MSCI World. There we have a number of roughly 60%. So the 15 largest companies of this index made 2/3 of the entire index performance. And now the question, you already gave the answer, but who knows how this number looks for the US? Fred, maybe you. 85? It's even larger, so it's 97. So the entire...
Five stocks drive an index in any one day. 5 stocks.
Yeah, so roughly. Yeah. So this is, I think this is... This is my reasoning now. Just hold on for a second. So basically, the 15 largest stock of the US made the entire performance of the S&P 500. Now, are we worried about that? No, because this is not sustainable. I mean, 15 stocks of the US don't represent the entire American economy. So at some point, it will come back to normal levels. But just because I think this was a funny way to summarizing the fact, if you want to show this in pictures, it will look like this. So furthermore, and jokes apart, we have a long-term value investment approach. We don't do any market timing. We are always 100% invested. So we won't be able to beat the market every month. But our goal is that in the majority of cases, we are better than the market in the month. So we just stick with the principles of our idol. Successful investing takes time, discipline, and patience. No matter how great the talent or effort, some things just take time. Now I was really wondering if I should say that, but you can't produce a baby in 1 month by getting 9 women pregnant. Okay. Good. So let's come to the summary of the Acatis AI US Equity Fund. It's a long-term stock-picking fund which is completely managed by AI. There's no human intervention in picking the stocks, only in constructing the models. The AI model, and that's really important, which differs us from many other competitors, is entirely based on fundamental company data. Okay, this is our investment style. We are a value house. We do stock picking. On top of that, we use a safety net where we analyze earning calls and try to detect risks in SEC filings to exclude potentially distressed companies. And then we build a long-only sector-neutral portfolio with 50 US or Canadian stocks. And the currency is in US dollar. And if I couldn't convince you of buying this fund or investing in the US, I just leave you with this quote. Thanks.
Any questions for Eric? With regards to sector pairing, how do you determine which these stocks are actually in actual sectors? Because some of these, do you use artificial? No. Is there a list or something?
There's a list. It's not our own list, but we use the list of the data provider. But there are always cases here where you can argue whether this really belongs to the sector or that sector. But that's how it is. I mean,
okay. And you said the market cap is 3 billion?
3 billion.
As opposed to the global equities, which was 1?
Which is, lower. Exactly. Yeah.
And, okay. And I guess this type of, who would you say who are your peers? Because this strategy with the data is not possible without artificial intelligence, correct? I mean, there's no way that you can get textual or, with NLP, whether it's voice or text, there's no way that you can harvest this type of data, but without artificial intelligence.
Yeah.
So who would you say are, you have a benchmark, but who would you say, your peers are if you're talking to an investor? Just
so
a U.S. equity strategy,
so
value?
I guess just from the approach, there's some recent development from the US. So because, first of all, it's a US fund, so we should compare it to a US fund as well. And there's some guys from Euclidean Technologies. They just launched an ETF, which from the spirit is very similar to our fund. Just from approaching AI, looking on fundamentals only and trying to do a long-term investment pick.
Mm-hmm. Okay.
One question. So will AI invest into AI firms?
I think,
it's a dilemma.
yeah.
Yeah, because we only have this global trend of the giants. Yeah, and we were talking about investments into AI firms and new firms. Yeah, and this is not a good model for an AI firm because we don't have so much data because a company is relatively new. And so the question is, will AI fund will invest into an AI company? I can see that because this is old school business. And I was working with a fund like this and it was not working. We were under the performance of the market. It was on Switzerland, maybe it was a different algorithm as yours, but we were always too late in the trend. So we were buying a little bit too late, going out a little bit too late, and on the long run, I lost a lot of money.
Okay, but our approach is completely different. We don't do timing. I mean, we buy stocks and hold them for a long time. Okay. And it doesn't matter if I buy it today or in 1 week. For me, it doesn't make any difference. There's, I think, 2 parts to your question. So first of all, if you in the morning they were giving me examples of AI companies, which were, I think, Alphabet, Microsoft, the big names. Yeah. So if they use AI and they are selling products of AI, and these are coming into their statements, to the financial statements. Okay, they're generating revenue, they're making profits. Then we can invest into these kind of companies. So I actually think we have Microsoft right now in the portfolio, but we will never find like a startup which is just growing. I mean, Ragnar would have to collect lots of money to get it to a 3 billion market size. Otherwise, you don't invest into it. But it has a reason as well, because for early or young companies, I mean, there's a lack of historical data, and if you don't have it, then we can't apply our tools. So we need. That's why we also set a market or market size limit for companies to invest into.
AI firms. Microsoft is not an AI firm.
Yeah.
Coming from software development.
Yeah.
Google is not an AI
No.
firm. Only.
So there's for example one pure AI company we track sometimes, which is called C3.ai, and I'm not sure whether you know it.
No.
Okay, but it's too small and.
Yeah. Also,
Be
Salesforce is
considered.
investing
Right.
500 million.
Not AI.
Okay.
It's AI, but it's not.
Yeah. So there's a lot of misuse of AI because it's a hot shit right now. So that's the reason why every company is an AI firm. And if you take a closer look, 80% are not really AI firms, but they have something related to AI. Yeah. And also Salesforce is now an AI firm. For me, the development was different, but thank you. I promise you a question. Eh?
By the way, there is an AI thematic strategy that uses artificial intelligence to identify it's passively managed. So there is, it's offered by a very large European asset manager. But I mean, Salesforce is, so it's just, you know, these thematic strategies, it's just that these companies that embrace artificial intelligence, so Salesforce embraces it and so forth and so on. So instead of calling it AI, let's just go back and call it artificial intelligence. So maybe that's sort of a way to do it. Eric, thank you very much. Yeah.